Big shakeup in the RV industry is underway, and unfortunately, it might not be so great for the customer, in my opinion.
Consumer Reports just confirmed it. The RV boom is officially dead. And millions of owners are about to regret every decision they made. Prices down, sales cut in half, entire towns losing the industry they depend on. And here's the part no one else will tell you. This collapse isn't just about vehicles, it's about the next wave of America's economy. Why did it happen now? Who's cashing in while everyone else loses? And what does it mean for you? Miss this video, and you'll miss the warning shot before it hits your job, your wallet, and your plans for the future. Consumer Reports alarm? Consumer Reports just sounded an alarm that few expected to hear so soon. The American recreational vehicle market is unraveling at a speed not seen since the crash of 2008. The watchdog's warning highlighted that prices for new and used RVs have fallen by roughly 1/4, while unit sales have been slashed in half compared to their pandemic peak. This is not merely a niche problem for road trippers. It is a visible indicator that discretionary spending in the wider economy is buckling under stress. Industry giants that once boasted of record order books now confront empty showrooms and anxious suppliers. The publication's announcement cast the downturn not as a seasonal wobble, but as a systemic reset that could foreshadow deeper trouble across consumer markets. For the millions of households that bought into the RV dream, the revelation is a jarring reminder that enthusiasm alone cannot hold up an industry forever. The trail of this collapse doesn't stop with the headlines. It runs straight into the mechanics of borrowing, the interest rate trap. When Consumer Reports examined the crash, one factor stood out: the cost of money itself. Recreational vehicles are almost always purchased with long-term borrowing, often stretching from 10 to 20 years. In the current climate, annual percentage rates have hovered near 8%, transforming what once felt like an indulgent monthly splurge into a crushing obligation. A rig priced near $50,000 may translate into a monthly commitment that rivals a mortgage, forcing potential owners to think twice before signing. Unlike traditional automobiles, these units depreciate quickly, leaving buyers without the sense of security that comes from stable collateral. The rate environment, therefore, is acting as a wall rather than a hurdle. Industry veterans say that buyers who stroll through dealer lots are still charmed by the glossy interiors and high-tech fittings, but the arithmetic on the payment sheet ends the conversation before it begins. Once the payment math crushes the dream, the costs waiting after purchase begin to speak even louder. Fuel versus budget. Operating an RV has never been cheap. But in the current climate, the ongoing drain on household budgets has become impossible to ignore. A trip across state lines involves paying for gallons of gasoline or diesel that stretch far beyond the efficiency of any family sedan. Campground fees that once felt modest have escalated, especially in popular destinations where demand still runs high. Insurance premiums have risen steadily, adding yet another line to the ownership ledger. Even routine maintenance, from tires to roof seals, has become more expensive due to rising parts and labor costs. All these recurring expenses pile up into a steady bleed that undermines the romantic image of carefree travel. Owners who might have been willing to swallow higher purchase costs during the pandemic now find themselves asking whether every journey is worth the tally at the end of the month. The dream of freedom on the open road is colliding head-on with the arithmetic of recurring bills. Those constant expenses sting even more because the surge of buyers that once carried this industry has already burned out. If this shocked you so far, smash the subscribe button and leave a comment. Your voice makes these investigations even stronger. Demand reverted. The most sobering insight in the Consumer Reports analysis is that demand has not simply softened, it has reversed. During the lockdown years of 2020 and 2021, recreational vehicles became a cultural escape hatch. Remote workers, families seeking safe travel, and retirees alike rushed to purchase units, pushing sales to record highs near 600,000. That surge effectively borrowed buyers from the future. Now, in 2025, the pool of willing households is thinner because many of those who wanted an RV already bought one. The social media glamour of van life has cooled. Workplaces have called staff back to offices, and discretionary travel has tightened. What is left is a market that overshot its natural demand cycle and is now enduring the payback. Consumer Reports frames this as the natural consequence of a pull forward. An industry that sprinted ahead only to stumble when the finish line was farther than expected. The retreat from showrooms tells only half the story. The real drama unfolds where these machines are actually built. Factory floor, blinking red. On the factory floor, the sense of urgency is palpable. Shipment volumes that once defined the boom years have been cut nearly in half, leaving assembly lines eerily quiet. Workers who used to race to keep up with a backlog of orders now find their shifts shortened or eliminated altogether. Suppliers that provide everything from chassis components to cabinetry report thinning schedules as manufacturers throttle output to match weaker demand. Forecasts that once promised steady growth have been revised downward, with projections hovering in the mid-300,000 unit range, rather than the 600,000 peak of 2021. The adjustment is not simply about scaling back. It reflects a structural change in expectations. Executives no longer talk about waiting out a dip, but rather about surviving a prolonged reset. In communities built around these plants, the slowdown is felt in fewer shifts, less overtime, and rising uncertainty about the future. While production lines slow to a crawl, investors are delivering their own ruthless judgment from trading floors. Wall Street verdict? Wall Street has been ruthless in its assessment of the downturn. Shares of major manufacturers such as Winnebago and Thor have fallen sharply as earnings reports reveal declining revenue and slimmer margins. Analysts note that the companies are not just reporting weaker quarters, they are guiding expectations lower for the coming year, signaling that the slump is not a short-term blip. Investor psychology has shifted from optimism about recreational vehicles as pandemic winners to concern about their role as symbols of overextended discretionary spending. Hedge funds and institutional players who once chased the rally now question whether the industry can deliver consistent returns in a high-cost environment. Each earnings call becomes a test of confidence, with every downgrade amplifying the sense of fragility. The market no longer rewards growth promises. It punishes any sign of weakness with swift sell-offs, leaving executives scrambling to preserve credibility. Numbers on Wall Street may tell one story, but survival strategies are being written daily on dealership lots. Dealer Survival Playbook. Dealers across the country are rewriting their business models to withstand the storm. With fewer buyers willing to commit to new units, showrooms increasingly highlight pre-owned inventory as the practical entry point for hesitant shoppers. Used sales provide a lifeline, turning what was once a secondary channel into a core business strategy. Service departments, often overlooked during the boom, are now central profit centers, with maintenance and repair work filling bays that might otherwise sit empty. Creative financial desks experiment with extended terms, bundled insurance, and loyalty incentives designed to keep prospects from walking away. The emphasis has shifted from moving high volumes of flashy new models to carefully curating a mix of affordable options and recurring service relationships. For many dealerships, survival hinges on treating each customer not as a one-time buyer, but as a long-term account that can generate steady revenue streams even in lean years. Even with clever tactics on the ground, the industry faces a tougher question. What happens when innovation itself runs dry? Research and development on a diet. Projects that promised bold advances, ranging from lithium battery integration to fully off-grid power systems, are now delayed or scaled back. Engineers accustomed to pitching ambitious prototypes are instructed to focus on incremental upgrades that can be marketed without heavy investment. The stagnation is not due to lack of imagination, but to the absence of revenue streams robust enough to fund experimentation. The industry's creative momentum, which surged when buyers seemed endless, now feels constrained by caution. Model year refreshes rely on cosmetic tweaks rather than structural breakthroughs, leaving the product pipeline looking stale. For consumers watching from afar, this slowdown may translate into fewer compelling reasons to return to showrooms once conditions improve. And for the companies themselves, starving innovation risks locking them into a cycle where they fall behind other sectors that continue to evolve. The slowdown behind the drawing board is only half the impact. Its ripple hits hardest in the lives of ordinary owners. Retiree calculus. For decades, retirees represented the backbone of the recreational vehicle lifestyle. Many dreamed of spending their golden years exploring national parks or visiting grandchildren scattered across the country. On a fixed income, however, every dollar must be measured against variable costs. Insurance premiums, site fees, and maintenance bills steadily chip away at pensions or savings accounts. What once looked like a manageable monthly commitment can feel daunting when medical expenses or unexpected household repairs compete for the same limited funds. Some older couples still commit, arguing that the joy of mobility justifies the expense. Others step back, concluding that the dream does not match the reality of the spreadsheets. The choice is rarely simple because the decision blends financial caution with deeply personal aspirations. When retirees weigh whether the freedom of the open road is worth the trade-offs, they highlight the tension between lifestyle ambitions and fiscal discipline. While older buyers weigh every dollar, younger generations confront an entirely different kind of reckoning. Millennials and Gen Z. For many millennials and members of Generation Z, the appeal of recreational vehicles was wrapped in lifestyle branding. Social media feeds filled with images of sleek camper vans parked beside mountain lakes or desert vistas. Influencers portrayed mobile living as an accessible path to freedom, creativity, and self-expression. Yet beneath the glamour, affordability has proven elusive. Younger households often juggle multiple obligations, and even modestly priced wobbles stretch budgets that are already fragile. In addition, the shift back to in-office expectations has undercut the work-from-anywhere fantasy that once made ownership attractive. The cultural mood has shifted. What was once portrayed as an adventure has begun to look, for many, like an expensive burden. Younger audiences still dream of the open road, but they increasingly sample it through rentals, weekend getaways, or digital escapism rather than full-fledged purchases. The gap between aspiration and reality is widening, forcing a reassessment of how sustainable the trend ever truly was. Beyond cultural dreams and social media hype lies a harsher reality: financial traps that refuse to loosen their grip. Negative equity ghost. Among the harshest consequences of the downturn is the specter of negative equity. Owners who bought units at peak prices now discover that the market value of their vehicles has fallen by 1/4 or more. When trade-in discussions reveal that a rig is worth less than the outstanding obligation, owners face a painful choice: keep paying for something they no longer want, or sell at a loss and bring cash to cover the shortfall. Online forums are filled with cautionary tales of families trying to offload oversized models only to realize they are financially underwater. Some attempt creative swaps or secondary loans, while others resign themselves to years of payments. The situation has transformed recreational vehicles from symbols of freedom into anchors of debt. This hidden weight haunts buyers long after the initial excitement fades, leaving them wary of ever entering the market again. Canary in the coal mine. The downturn in recreational vehicles has become more than an industry story. It is a signal for the wider economy. Economists often treat discretionary big-ticket purchases as leading indicators because they rely on optimism and surplus income. When such categories falter, the implication is that households are tightening belts across the board. The slump in recreational vehicles mirrors weakness in housing transactions, declining demand for sport utility equipment, and slower sales in other leisure sectors. Together, these shifts suggest that consumers are bracing for leaner times ahead. Policymakers and investors watch these patterns closely, interpreting them as harbingers of broader recessions. In that sense, the industry is not an isolated casualty, but a canary in the coal mine, warning of pressures spreading through the economy. What happens on dealer lots in Indiana or Arizona may tell us more about national confidence than abstract charts and forecasts. When personal finances unravel, the signal spreads outward, offering a grim preview of the wider economy. Manufacturers hedge the cycle. Manufacturers are responding to the downturn with a kind of quiet discipline that contrasts sharply with the exuberance of the boom years. Instead of pushing every unit they can build, they are throttling production to maintain pricing power and avoid flooding the market. Selective incentives are being deployed, not as across-the-board discounts, but as carefully targeted offers for models most at risk of clogging up distribution pipelines. This controlled release strategy is designed to preserve brand value while keeping factories running just enough to support their supply chains. Executives now talk less about maximizing growth and more about optimizing survival, emphasizing flexibility and lean operations. The goal is to stretch resources until conditions stabilize, while holding back just enough firepower to capitalize when confidence returns. It is a delicate balance, and missteps could either leave companies without inventory when demand rebounds or swamp them in unsold units if caution proves excessive. Those warning signs echo far beyond consumers, forcing manufacturers to rethink how they play the long game. Dealers as portfolio managers. Dealers no longer think of their lots simply as spaces to showcase recreational vehicles. They now view them as carefully curated balance sheets. Every unit sitting on asphalt represents capital that must be managed, rotated, or leveraged. The old model of stuffing lots with flashy new arrivals has given way to a measured mix of pre-owned bargains and selective new offerings, designed to appeal to different buyer segments. Used inventory, once treated as secondary, has become a hedge against uncertain demand, often generating faster turnover and healthier margins. Cash flow management is paramount, with many dealers timing purchases and sales to avoid overextending themselves in a slow season. Service and parts operations are folded into this portfolio approach, producing steady streams of revenue that balance the volatility of vehicle sales. The dealership has effectively become a miniature investment fund, where the assets happen to be motorhomes and towables rather than stocks or bonds. Strategies in the boardroom mean little without execution on the lot. where dealers must treat inventory like capital on a balance sheet. Politics, fuel, and the open road. Recreational vehicles exist at the crossroads of lifestyle and policy, and government decisions ripple through the industry in ways that buyers may not immediately see. Regional tax structures create disparities in operating costs between states, meaning a cross-country trip can feel dramatically different depending on where it begins. Tariffs on imported materials affect the price of components, quietly pushing manufacturers to adjust margins or redesign supply chains. Fuel policy, from refinery standards to environmental regulations, influences the price at the pump and therefore the cost of every journey. Washington debates about infrastructure spending or environmental mandates can tilt the playing field toward either expansion or contraction in future years. For the industry, these policy levers are as impactful as consumer sentiment, shaping the economics of travel and production alike. Stakeholders understand that survival depends not only on what they do in boardrooms, but also on what lawmakers decide in committee rooms. Even the sharpest dealer playbook can be overturned by forces outside the market, shaped in capitals and fueled by regulation. What consumers and investors do next? For consumers, the smartest move in this climate is patience and vigilance. Prospective buyers should study market data carefully, negotiate assertively, and consider whether a towable unit might provide the same freedom at a fraction of the cost of a motorized model. Rentals and seasonal ownership can offer the experience without the long-term commitment, allowing households to test whether the lifestyle truly fits. For current owners, focusing on maintenance and preserving value is critical while waiting for conditions to stabilize. Investors, meanwhile, should resist the urge to chase quick rebounds. Balance sheet strength, operational discipline, and market share gains matter more than flashy growth promises. Companies that demonstrate careful management now are best positioned for a healthier future when the cycle turns. The message for both groups is the same: resist panic, act deliberately, and recognize that downturns are temporary, but decisions made in haste can last for decades. And with that, the story of the crash turns outward, reminding us that what happens on the open road often mirrors the journey of the entire economy. Thanks for watching. If this opened your eyes, subscribe now, like the video, and share it. Stay alert, because the next collapse is already coming.